In November 2008, someone going by the username Satoshi Nakamoto released a paper to a cryptography mailing list. The 9-page paper was entitled Bitcoin, a peer-to-peer electronic cash system, and it laid out a vision for a distributed digital money system. In January 2009, Satoshi Nakamoto released the first version of the open-source Bitcoin core software on SourceForge, and the Bitcoin protocol started running. People other than Satoshi Nakamoto were actively contributing to the open-source codebase in GitHub. The protocol was a breakthrough in cryptography, though it drew on many cryptography innovations that preceded it. A community of cryptography experts and privacy advocates known as the cypherpunks played a key role in recognizing the technical genius of Bitcoin and understanding its implications. Many members of this community would become torchbearers later in Bitcoin's history. As 2009 ended, Bitcoin did not have a trade price as of yet. The Bitcoin ecosystem was largely just a record of Bitcoin's transactions, like the blockchain, a set of online forums where users communicated and organized transactions, and the open-source software code. There were no wallet services, payment processors, or real user interface beyond actual command prompts and raw code. This limited involvement to a dedicated and savvy crowd who organized transactions through online forums and initiated them on the blockchain with code. For example, the first commercial transaction took place in May 2010. A programmer in Florida spent 10,000 BTC on a pizza. However, beginnings of a market support system began to emerge. In early 2010, the first exchange opened, which allowed structured trading of Bitcoins. Users grew, and in late 2010, Mt. Gox launched as the second exchange and became the dominant place to trade Bitcoins for a couple of years. As 2010 ended, the price of one Bitcoin was 30 cents. In 2011, Bitcoin began to mature as a digital payment system, though its use was limited by the aspirations of early adopters. The perceived anonymous nature of the digital currency made it perfect for online black markets. That year saw the emergence of the Silk Road, an eBay for illicit goods, predominantly drugs, that used Bitcoin as a payment method. The Silk Road was one of the public's primary introductions to Bitcoin, prompting several politicians to cast the currency as a vehicle for money laundering and drugs. Mainstream media also began covering it. Forbes, Bloomberg, and Time all wrote articles. Politicians warned against it. Academics wrote about it. BitPay, a service that let merchants accept Bitcoins over the phone, was founded and claimed to have 100 merchants. More exchanges opened, letting people trade Bitcoins for other currencies. Also in 2011, the first alternative digital currency, or altcoin, Litecoin, launched. The world was in an awkward time in which financial markets were doing well, but workers were not. Occupy Wall Street started in September, and soon Occupy protests had taken place in almost 1,000 cities worldwide. It is easy to see how the idea of a bankless currency could take root. As 2011 ended, the price of one Bitcoin was $4.60. Bitcoin was riding a wave of legitimacy in many circles, and these were having conflicting effects. The currency became a popular target for hackers and thieves. Mt. Gox had been hacked in 2011, and now more major attacks on exchanges and other databases led to millions of dollars worth of Bitcoin theft. Several Ponzi schemes ended with theft. Black markets utilizing Bitcoin as a payment method continued to operate. It's estimated that $15 million worth of Bitcoin passed through the Silk Road this year. A popular online gaming site, Satoshi Dice, launched and flooded the Bitcoin network with very small gambling transactions. This sparked a debate on how to deal with such transaction dust. As it garnered the attention of more governments, its legal ambiguity became more obvious and more awkward. People were trading it like an asset, using it like a currency, and downloading it like open-source software. Gambling and the Silk Road didn't help. Some services started dropping Bitcoin out of fear of its legality. As 2012 ended, the price of one Bitcoin was $13. 2013 was one of the most tumultuous years for Bitcoin. It had two periods of incredible volatility in which people literally woke up to almost 100% price increases. The first occurred in early 2013. A bailout deal between the EU and Cyprus included a levy on bank accounts with sizable sums of money, inspiring Cypriot account holders to buy Bitcoin en masse. The Bitcoin price almost doubled, and Cyprus set a precedent for using Bitcoin as a means of capital flight. Bitcoin survived one of its first major crises of legitimacy in this very year, the shutting down of the Silk Road and the arrest of its founder. The government seized all assets and helped cement public association of Bitcoin with online black markets. After a quick price drop, the price quickly recovered, but Bitcoin has lived in the Silk Road's shadow ever since. U.S. Financial Crimes Enforcement Network issued some of the world's first Bitcoin regulation in the form of a guidance report for persons administering, exchanging, or using virtual currency. In particular, exchanges must comply with money laundering laws and register as money services businesses. The second period of volatility occurred in November. In 30 days, the price went from just over $100 to over $1,200. Searches for Bitcoin spiked. News outlets covered it, and in 30 days, it went from a successfully digital currency proof of concept to a new technology in the eyes of the world. As 2013 ended, the price of one Bitcoin was $764. In early 2014, Bitcoin survived another major crisis of legitimacy, the closure of Mt. Gox. Mt. Gox had been the longest-running and most successful virtual currency exchange to date. It was a pillar of both the Bitcoin economy and the community. In February, Mt. Gox abruptly shut trading and leaked documents showing it had lost 744,000 BTC, approximately $40 million. Governments began to pass regulation this year. The wild end to 2013 woke up many regulators to the volatility of this currency. The IRS declared Bitcoin to be taxed as property. A wave of new protocols emerged with applications beyond digital currency, presaging a so-called Bitcoin 2.0 era in which people would repurpose blockchains to store all kinds of information. Some notable ones included Ethereum, a platform for software that could run on a distributed network, made Safecoin, a protocol to allow distributed file storage built on top of the Bitcoin blockchain. Factom launches to create a data layer on the top of the blockchain to enable simple, verifiable, and secure record keeping. As 2014 ended, the price of one Bitcoin was $314. The basic features of this industry mostly continued. Hacks and theft continued, including a high-profile loss of close to $5 million from a major exchange at the beginning of the year. Regulators around the world continued to explore the implications of this technology while also proving that users of Bitcoin are not beyond the reach of the law. The biggest shift came from banks and industry. Many industry executives began talking about blockchains and distributed ledgers rather than Bitcoin. Microsoft launched blockchain as a service on its Azure cloud computing platform. This likely contributed to the growth in interest in Bitcoin among the broader public and among traders. Bitcoin's price began a steady ascent as people started realizing Bitcoin and blockchains were still around. The Bitcoin protocol was designed to process approximately 7 transactions per second. The blocks in the blockchain were not large enough to store more. Members of the community realized Bitcoin was on pace to reach that in 2015. If nothing was done, it could stymie the currency's growth in popularity. In Bitcoin, there are no democratic rules, public sanctioned spaces to gather, or Robert's Rules of Order. Reddit, Bitcoin Talk, and a couple other online forums were serving as venues for public discussion. People started talking seriously about other currencies that might be viable alternatives to Bitcoin. Ethereum topped that list, and in early 2016, its price would increase tenfold. As 2015 ended, the price of one Bitcoin was $426. Many of the trends that amalgamated in 2015 continued. More enterprise and corporate interest in blockchain technology, more uncertainty over the block size debate, and some price volatility. Security remains an issue. Just this year, Gatecoin, a major exchange based in Hong Kong, lost $2 million and suspended trading. Shapeshift, a major US-based exchange, suffered a series of hacks in a saga that reads like a crime novel. Broadly, industry players in finance and technology remain bullish on blockchain and ambivalent about Bitcoin. More and more startups are branding themselves as blockchain companies rather than Bitcoin companies. A new ambivalence about Bitcoin has emerged, not as a dangerous quasi-legal currency, but as a good proof of concept that ultimately won't be ready for prime time. As they say, the pioneers get the arrows, the settlers get the land. At a premier industry conference, some compared Bitcoin to Netscape. But Bitcoin's price continues to rise. How does Bitcoin work? Unlike normal currencies, Bitcoin doesn't have a central bank or the backing of a government. Instead, it is regulated by complex algorithms, with new coins being mined when computers solve complex equations. All of this number crunching is tracked by the blockchain, a public ledger of all transactions which is distributed, meaning there is no central point in the network that can be shut down. It is perhaps analogous to file-sharing protocol BitTorrent. You can obtain bitcoins by mining them yourself or buying them from an exchange, but for that to happen, you'll first need a wallet. There are different ways to get a wallet. You can simply store bitcoins on your hard disk in wallet software running locally, or you can use an online service and have your coins stored in the cloud. Both have advantages and disadvantages. For example, if your coins are stored locally, if something physically happens to your computer, such as your hard disk getting destroyed, you lose your cash. Conversely, if your coins are stored online with an exchange, they're more likely to be an attractive target to hackers. Famously last year, Mt. Gox, which was one of the largest Bitcoin exchanges, was hacked, resulting in the virtual heist of 450,000 Bitcoins, which were then valued at about $450 million. While some coins have since been recovered, a large number are still missing. Due to the way the Bitcoin protocol works, it simply wasn't possible to hit the undo button, so choose your wallet wisely. There are two different ways to get a hold of Bitcoin. You can either simply buy them from a Bitcoin exchange, imagine something just like a bureau de change, or you can mine them yourself. Buying is the cheapest option. There are a number of different methods to buy coins, just as there are many different ways that banks can manipulate money. Perhaps the most straightforward way is to buy it from an exchange like CoinFloor or CoinCorner. With these, it is simply a case of signing up, validating your identity so the exchanges know you're not laundering money, and you're good to go. Exchanges work just like any other sort of financial exchange, with buyers and sellers setting the prices they're willing to buy and sell for, and the exchange matching people together to make trades. There's also comparison websites for Bitcoin exchanges like BittyBot, which will display the current prices. Another way to get a hold of Bitcoins is to mine it for yourself, which is increasingly a game of diminishing returns. To do this, you need a price of software on your computer that can crunch the numbers used to slowly generate more Bitcoin. The trouble with this approach is that Bitcoin is designed so that there will only ever be a finite number of coins available, meaning that given the relatively meager computing power you probably have available versus everyone else, it might cost you more in the electricity to run your computer than it would return in value in Bitcoins. There also exists Bitcoin mining pools like Bitminter, which has everyone working together to mine coins, sharing the proceeds between each other too. Each Bitcoin wallet has a unique Bitcoin address, a long string of numbers and letters that effectively does the same job as a 12-digit credit card number. Depending on where you buy from, you may be asked to either send coins using your wallet to a specific address, or you'll simply be able to click through and log in with your Bitcoin wallet, a bit like paying with PayPal, depending on how the retailer is set up. In some cases, a QR code may be generated, which you can simply scan with your wallet app on your phone to make the payment. Bitcoin has a bit of a controversial reputation because of its relative anonymity makes it useful for people who want to buy drugs and guns and so on, but it isn't just for criminals. Lots of normal places now routinely accept Bitcoin. Last year, PayPal announced it would start giving merchants the option to accept Bitcoin. Sadly, this doesn't mean that you can pay anywhere you like with Bitcoin, but if individual shops have enabled it, you can use Bitcoins. As we know, all currencies will fluctuate, but Bitcoin will likely fluctuate more than most until it is established. This means that if you buy at the right time and the price shoots up, there could be lucrative rewards. But it also means that if you buy at the wrong time, you could end up a loser. It perhaps isn't worth entirely giving up on the pound just yet. The Bitcoin Volatility Index is a good source of information on this. Looking at the current chart, volatility appears to have decreased over recent months, though still varies more than gold or other major currency. There are also economic critiques of Bitcoin. For example, one of the key things about Bitcoin is the way it is designed, but also arguably one of its drawbacks is that it is not backed by any government. This could be a mixed blessing. It could be good as it means that the government can't arbitrarily decide to manipulate Bitcoin, but it could also be bad as it means that the government can't arbitrarily decide to manipulate Bitcoin. You see what I did there? Bitcoin protects you from the government deciding to print more money, thus devaluing the contents of your wallet. But not being able to print money also means that Bitcoin risks falling into a liquidity trap, meaning that more money cannot be printed to try to stimulate spending if the economy slows down. Ultimately, Bitcoin is new, exciting, and could be lucrative, but it exists in a virtual Wild West. So go ahead and take the plunge, if you dare. The design of Bitcoin makes it acceptable as a virtual currency, with distributed systems, cryptography, and scarcity that give it the stability and security that a good currency demands. But as a fiat currency, it has the same main benefits and risks as most other currencies. Namely, it is faith that gives it value. People must believe that Bitcoins have value to others, otherwise they are just holding a bunch of keys that no one else wants. The biggest threats to this faith are governments who might crack down on Bitcoin use as a result of anonymous purchases of illicit goods and the potential for money laundering and international transfers. The US dollar, the euro, and most currencies around the world are fiat currencies, meaning they have no tangible value beyond that perceived by the people who trade with them. As a thought experiment, imagine what would happen if, overnight, 90% of businesses in the US accepted seashells as payment instead of US dollars. The value of your dollars, for example, what you could trade them for, would drop dramatically. The demand for dollars would then significantly decrease, corresponding with a rapid increase in the demand for seashells. To keep the value of dollars stable, scarcity is required. Rules and regulations on accounting practices ensure that electronic forms of money, such as online payments, adhere to this concept of scarcity. Bitcoin is a virtual currency that is also a fiat currency. There are no tangible assets attached to it. It works because people trust that they will be able to trade with it in the future. Developed in 2009 by an anonymous group of developers, it is not just a novelty social experiment. There are around 16 million bitcoins in circulation today, valued at over $14 billion. To use and track bitcoins, a user typically has a wallet, which is a file that holds the IDs of the bitcoins they own. The blockchain is a public ledger of all the transactions performed with bitcoins. Whenever a user performs a transaction, the blockchain is updated with the transaction. This transaction is publicly verifiable because the blockchain allows the lifetime of a bitcoin to be viewed by anyone. What makes Bitcoin a viable currency is the existence of miners. Miners are entities which manage and process blockchain data. Notably, anyone with the right equipment can be a miner. This distribution is one of its most attractive features because it means that the currency is not under the control of any single government or party. The Bitcoin core is open source, which makes it less likely to be hijacked by malicious code that could violate the system. The miners update and secure the blockchain by repeatedly verifying and collecting newly broadcast transactions into a new group of transactions called a block. The blockchain is kept consistent, complete, and unalterable by the miner producing a hash based upon the transactions in the block and the previous block it is connected to. The hash is a string of characters derived from an algorithm that acts as a seal of authenticity for the block data. However, the block isn't deemed to be complete unless the miner can show proof of work, which is essential for trust. Any change to the transactions already stored in the blockchain would produce a different hash. If this happens, it indicates the blockchain has been tampered with. The existence of all fiat currencies depend on faith. Theoretically, Bitcoin has key features that give people faith in the currency, namely integrity, stability, and other people with whom to transact. The latter point is tied to the first two. People are comfortable with using bitcoins because they know their bitcoins are secured. They feel its value won't fluctuate hugely from day to day. More on this shortly. And there are increasing numbers of people willing to transact with Bitcoin. Some people are buying Bitcoins hoping to speculate on growth, but even these entities need to be able to transact at some point. The value of Bitcoins is fluctuating, however, but only compared to other currencies. This is a difficult difference to understand because we as individuals are used to assessing value in terms of the currencies we understand, namely US dollars. Mining is the process of adding transaction records to Bitcoin's public ledger of past transactions. This ledger of past transactions is called the blockchain, as it is a chain of blocks. The blockchain serves to confirm transactions to the rest of the network as having taken place. Bitcoin nodes use the blockchain to distinguish legitimate Bitcoin transactions from attempts to respend coins that have already been spent elsewhere. Mining is intentionally designed to be resource-intensive and difficult so that the number of blocks found each day by miners remains steady. Individual blocks must contain a proof of work to be considered valid. This proof of work is verified by other Bitcoin nodes each time they receive a block. Bitcoin uses the Hashcash proof of work function. The primary purpose of mining is to allow Bitcoin nodes to reach a secure, tamper-resistant consensus. Mining is also the mechanism used to introduce Bitcoins into the system. Miners are paid any transaction fees as well as a subsidy of newly created coins. This both serves the purpose of disseminating new coins in a decentralized manner as well as motivating people to provide security for the system. Bitcoin mining is so called because it resembles the mining of other commodities. It requires exertion, and it slowly makes new currency available at a rate that resembles the rate at which commodities like gold are mined from the ground. Mining a block is difficult because the SHA-256 hash of a block's header must be lower than or equal to the target in order for the block to be accepted by the network. This problem can be simplified for explanation purposes. The hash of a block must start with a certain number of zeros. The probability of calculating a hash that starts with many zeros is very low. Therefore, many attempts must be made. In order to generate a new hash each round, a nonce is incremented. The difficulty is the measure of how difficult it is to find a new block compared to the easiest it can ever be. It is recalculated every 2016 blocks to a value such that the previous 2016 blocks would have been generated in exactly 2 weeks had everyone been mining at this difficulty. This will yield, on average, 1 block every 10 minutes. As more miners join, the rate of block creation will go up. As the rate of block generation goes up, the difficulty rises to compensate, which will push the rate of block creation back down. Any blocks released by malicious miners that do not meet the required difficulty target will simply be rejected by everyone on the network and thus will be worthless. The discoverer may award themselves with a certain number of bitcoins, which is agreed upon by everyone in the network. Currently, this bounty is 25 bitcoins. This value will halve every 210,000 blocks. Additionally, the miner is awarded the fees paid by users sending transactions. The fee is an incentive for the miner to include the transaction in their block. In the future, as the number of new bitcoins miners are allowed to create in each block dwindles, the fees will make up a much more important percentage of mining income. Users have used various types of hardware over time to mine blocks. Hardware specifications and performance statistics are detailed on the mining hardware comparison page. Early Bitcoin client versions allowed users to use their CPUs to mine. The advent of GPU mining made CPU mining financially unwise as the hash rate of the network grew to such a degree that the amount of Bitcoins produced by the CPU mining became lower than the cost of power to operate a CPU. The option was therefore removed from the core Bitcoin client's user interface. For the amount of power they consume, they are vastly faster than all previous technologies and already have made GPU mining financially unwise in some countries and setups. Mining contractors provide mining services with performance specified by contract, often referred to as mining contracts. They may, for example, rent out a specific level of mining capacity for a set price for a specific duration. As more and more miners competed for the limited supply of blocks, individuals found that they were working for months without finding a block and receiving any award for their mining efforts. This made mining something of a gamble. To address the variance in their income, miners started organizing themselves into pools so that they could share rewards more evenly. See pooled mining and comparison of mining pools. History. Bitcoin's public ledger, the blockchain, was started on January 3, 2009 at 8:15 UTC, presumably by Satoshi Nakamoto. The first block is known as the Genesis block. The first transaction recorded in the first block was a single transaction paying the reward of 50 new Bitcoins to its creator. There have been some complications for the Bitcoin, the virtual currency created in 2009 by an anonymous programmer under the pseudonym of Satoshi Nakamoto. The key feature of this currency is its peer-to-peer payment system, user-to-user, without intermediaries. Its acceptance as a means of payment ultimately depend on the confidence generated by the currency. However, doubts have emerged regarding its security with the disappearance of Mt. Gox, to date the main platform for trading and handling Bitcoins, victim of a massive theft by hackers. Operating with Bitcoins requires both parties in a transaction to have accounts called Bitcoin wallets. To transfer the currency, sellers must give buyers their password and buyers send Bitcoins to sellers using a software application. The Bitcoin user network provides the computing power of its members' devices for the system to verify that the vendor is the legitimate owner of the transferred Bitcoins and to register the transaction. A virtual currency such as the Bitcoin can have several advantages. Firstly, its low transaction costs in comparison with the commissions charged for credit card payments or the cost associated with a bank transfer. However, the security offered by the Bitcoin system is still not comparable to that of traditional payment systems. For example, it's more vulnerable to theft via hacking, particularly by those who devote themselves to illegal activities, is the almost anonymity in transactions and the fact that bank account numbers or credit card details do not need to be shared. Moreover, users can also generate several different Bitcoin addresses to differentiate and isolate each transaction. Lastly, another attractive feature of this system is that it has been designed in such a way so that the supply of Bitcoins, the total number of units in circulation, grows at a pre-established rate until reaching a maximum of 21 million, the current supply being 12.3 million units. Nevertheless, the Bitcoin's value rose dramatically in 2013 with high associated volatility, from $10 per BTC to more than $1,200 per BTC. Its value is now slightly below $550 per BTC after the hacker attacks suffered on some Bitcoin exchange platforms and the closure of Mt. Gox. The first transaction with Bitcoins was carried out in 2010, 2 pizzas for 10,000 BTC. The price of these pizzas at the current Bitcoin value would be close to $5.5 million. Traditional financial institutions and large technology firms may want to introduce their own virtual currency systems. For these systems to be widely accepted, they must take some of the key virtues of the Bitcoin, an agile medium of exchange with low transaction costs, and generate enough confidence for their exchange rate against legal tender currencies to remain relatively stable. These systems, potentially more secure, faster, and with lower transaction costs in terms of lower energy consumption or computer memory, and which would inspire more confidence, could take over and lead to the Bitcoins in circulation plummeting in value. They will be an acid test for Bitcoins, whether they are worth $1,000 or $100. What does the future hold for Bitcoin? Bitcoin has been around since late 2008, but it only started making the news in early 2013. It is a cryptocurrency and a payment system, its main advantage being that transactions are anonymous and peer-to-peer, made directly without an intermediary. Bitcoin's unique architecture is set up in such a way that their creation, or mining, gets progressively more resource-intensive, and total production will be limited to 21 million Bitcoins. It's certainly an interesting concept with many advantages, but also some important disadvantages. For example, Given its pseudonymous nature and that Bitcoin address owners are not explicitly identified, such transactions are effectively anonymous. However, this anonymity has been known to attract transactions from illegal activities, the best known example being that of the Silk Road website. This has been a problem with regulators and officials, as they recognize it as a medium for illegal transaction. Bitcoin has been recognized as a currency in many countries, and as of today, it's the most liquid and widely accepted cryptocurrency in the world. However, there is a long list of alternate cryptocurrencies that are eager to grab market share and challenge Bitcoin's dominance. And what about the 21 million Bitcoin limit? It's possible that once that ceiling becomes severely limiting, users will turn to other cryptocurrencies, effectively increasing the global supply. Bitcoin trades continuously on exchanges around the world in a very quick and straightforward manner, and it is conveniently stored electronically in wallets. However, having online wallet providers introduces an extra risk factor that cannot be ignored. One such example is the security breach at Mt. Gox in 2011, which sent shockwaves in the cryptocurrency community. At the time, Mt. Gox was handling around 70% of all Bitcoin transactions, and one day it declared that around 850,000 Bitcoins had been stolen. Soon after, the exchange suspended trading and filed for bankruptcy. It's this potential security vulnerability that makes many people skeptical when it comes to cryptocurrencies. Bitcoin price has been very volatile since early 2013 when it was trading between $10 and $15, and soon afterwards it went on a parabolic rise to hit a high of $1,163 within the same year. It spent the next 18 months dropping all the way back down to $200, but then went on the ascent again as global uncertainty persisted. It made the news once again in late 2016 when there was a China-led buying spree, mainly from people trying to escape the yuan's devaluation. Its simplicity, anonymity, and transaction ease made it a very popular choice among the Chinese. In early 2017, it almost hit an all-time high, peaking at $1,140, and at that point, the Chinese central bank made an important announcement. The CB said that it wanted to investigate Bitcoin transactions in market manipulation, money laundering, and unauthorized financing. At the time of writing, BTC is trading at $828, which represents a staggering 2-week drop of over 37%. So what's next for Bitcoin? It has many advantages, and for this reason it will remain relevant as a currency. The vast majority of BTC transactions by volume are made in China, so the two will remain interlinked. We see the biggest risk to Bitcoin being its substitution and/or parallel use by other cryptocurrencies. Bitcoin die-hard fans claim that this is never going to be an issue since Bitcoin was the pioneer and as such enjoys first-mover privilege. This argument is probably flawed because although the BTC is used for payments, this is only a relatively small percentage of all Bitcoins. What is increasingly likely is that the future of Bitcoin is bright. It is the 7th year in the development of this network. It takes years to build out a protocol and perfect its operation. Once the infrastructure is built, which still has many more years ahead of it, with companies like Blog, BitGo, 21.co, and Coinbase leading the charge, we'll begin to see solid programs built in the application layer. But even while we wait for the infrastructure to be built, it's clear that Bitcoin is evolving. Bitcoin is not perfect. It has a lot of problems that it is going to have to overcome. But to label it dead or to call for it to be replaced by something new is naive and short-sighted. New applications will be built that provide more use cases for different audiences, and ultimately, the internet will get its first true payment protocol. It will take many years for the infrastructure to be laid and for these applications to reach critical mass. Facebook had nearly 20 years after the browser was released to reach 1 billion users. To imagine Bitcoin's true potential, we need to think in decades, not in months or years. Fortunately, we are well on our way.